School of Law students, welcome to today's lesson. Our unit is Fundamentals of Accounting and Bookkeeping. Our topic of coverage is double entry concept, otherwise known as duality principle. So for this particular generally accepted accounting principle, it basically opines that for every business transaction, it will have a twofold effect, or what you refer to as a double effect. In that case, this double effect is in such a manner that there will be, or for every debit entry, it will have a corresponding credit entry of a similar amount. So a business transaction, of course, we know it as any event that occurs in the business and has monetary worth or can be equated in terms of monetary worth. The increases or decreases will affect the various types of accounts used in accounting. And in this case, to understand the decreases and increases, we generalize these particular transactions. Generalizing will entail the use of T accounts, which now form the building blocks of accounting. So which are these types of accounts? We generally have them as 5. We got assets, liabilities, owner's equity, otherwise known as capital, and revenue and expenses. If we make reference to the first set, these 3 accounts, they make reference to the statement of financial position or statement of financial affairs, otherwise known as the balance sheet. With revenue and expenses, they constitute what we refer to as the comprehensive statement of income or trading profit and loss account. So, how then do we treat these increases and decreases? Let's take a look at the first instance. We understand that the accounting equation is simply in regard to the statement of financial position, we have assets equal to liabilities and owner's equity. So on one side, when we talk of assets, they are simply the resources that the business has. Liabilities and owner's equity, on our right-hand side, we are simply focusing on these resources, but who supplied them. So in the first instance, liabilities will simply refer to the external parties, third parties in the organization, while owner's equity or capital, they are simply the owners of that particular business. For an asset account, we debit increases and we credit decreases. For the accounting equation to uphold, the opposite happens. And therefore, debit decreases in both liabilities and owner's equity, as well as credit increases in both liabilities and owner's equity. Say, for instance, you visit your commercial bank and withdraw money. The impact of that transaction will be your bank account will reduce, say with 10,000 shillings, while your cash at hand will increase with 10,000 shillings. So technically, cash at bank or bank balances and cash at hand, it's simply an asset. And therefore, we are going to debit cash account with 10,000 shillings and credit bank account with a similar amount, 10,000 shillings. Let's take an example in the second scenario where we have liabilities. Liabilities are simply parties that the business owes money. Say, for instance, you acquire stock or you acquire inventory from XYZ Limited, who is your supplier. So stock acquired on credit, probably 3,000 shillings. The twofold effect is your stock account will have increased while your creditor, in this case XYZ, will equally increase. So in this case, stock account we are going to debit by virtue of the fact that it's an asset, and then we open a creditor's account, and of course remember to credit 3,000 shillings, of course as a result of the stock acquisition. In the third part, the third type of account, we have owner's equity, otherwise known as capital. Of course, remember that this is sums or contributions made available by the owners of the business. So we debit for decreases and we credit for increases. Assuming that you start off a business on the first day of August with 50,000 shillings. The twofold effect is cash account will have increased, and therefore will debit with 50,000 shillings, while capital or owner's equity account will have increased, and therefore we credit with 50,000 shillings. Take another scenario. Of course, now in this regard, in the other two accounts, revenue and expenses. These ones, they simply form the basis of comprehensive statement of income, formerly known as trading profit and loss account. So we have revenue as cash flows or cash inflows into the business other than from the sale of general merchandise. Expenses, again, on the other hand, we consider them to be cash outflows or money spent other than to acquire general merchandise with the intent of resale. If we focus on the first bit, revenue, we debit decreases and credit all increases. So what are some of these revenue? If you make reference to, say, the trial balance, by virtue of the fact that they form part of income, these accounts will be credited. So in that case, examples would be rent received, discounts received, interest received, dividends received, and so forth. Take a look at expenses. We consider them to be, of course, you've said they are simply the cash outflows. So we'll have payment of salaries and wages, payment of rent, say repairs and maintenance, discounts allowed, depreciation charges for the year. Take an example of the business received shilling 10,000 as discounts. So on the cash book, you'll have considered an increase, and therefore will debit cash with, say, the 10,000, and then we have discounts received as a revenue account, and we credit with 10,000 shillings. So one thing you realize is we have a debit and a corresponding credit entry. Next, expenses. We can take an example of paid rent for the month, 5,000 shillings on account. So the impact is our bank account will have decreased while our expenses account will have increased. So if bank account decreases with 5,000, of course, we will credit that particular transaction by virtue of the fact that bank is an asset, and then of course rent account we will debit with 5,000 shillings. Now, one thing I would like us to note is the moment we have a comparison between revenue and expenses, it helps us to find out if the business is making a profit or incurring losses by virtue of the fact that the difference between revenue and expenses will either give us a net profit or a net loss. Having done that, the next bit will entail the balancing or setting off of these particular accounts. And this is purely done by comparing the total debit and the total credits. And then we offset with the difference. Say for instance, you have on the cash account, debits are 100,000 shillings and credit we have 50,000 shillings. So we will set off that cash account with a balance of 50,000 shillings. And the interpretation of that is the amount of cash at hand for the business is 50,000 shillings. So with all the various transactions that a business will have recorded, you will compare the debit and the total credits, and then you set off. Now this actually forms the starting point of the trial balancer, whereby all these list of closing balances will be used. And then of course with that it becomes the first process towards preparing the final accounts. Thank you.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.